Sometimes I like to do these tutorial videos where I try to share lessons and things I learned the hard way with you guys on YouTube. So maybe you could learn from the mistakes I've made instead of you going and repeating the same mistakes I did. And a lot of you enjoy these videos. I'm going to be doing more of them as I gain more and more subscribers on YouTube. So thank you for supporting me. And in today's video, I'm going to share with you a small list. I call it the not to do list, or things you shouldn't do, things you should avoid, and that will help you save a lot of money in the market. Of course, I'm not telling you what to do or anything. I'm just sharing with you what I experienced and mistakes I made and things I try to avoid as much as possible. And I see a lot of people making these mistakes. So I think it's going to be a very helpful video, and I think a lot of you will enjoy it. Now, the first thing that I believe most people should avoid in the market, and this is a big one, I'm seeing a lot of it recently, and it's mainly the merger arbitrage. I'm sure you've seen some kind of video, some kind of post on Seeking Alpha, some kind of article, maybe doubting some kind of a stock that's getting acquired by a larger company, and this stock is trading at $70, but the acquisition price is at $80 or $85. So you buy the stock at 70, and then the acquisition goes through is in a few months. It goes to 80 or 85. You make 10 or 15% risk free, or even 20% risk free, and that's it. It's very basic, it's easy money. I'm sure you've seen many of that. And to me, this is the easiest way not to make money, but it's the easiest way to lose money in the stock market. I would avoid this at all costs, because the truth is that yes, sometimes this is true. And sometimes you could make 10 or 15% by whenever the spread closes on the acquisition price and all these fancy things, and it sounds very smart. But what if it doesn't work out? Well, I'm going to show you two examples of what happens to the stock if the merger, for some random reason, doesn't work out. The first one is iRobot. iRobot was getting acquired by Amazon, and people were buying it because Amazon is acquiring iRobot. iRobot is a very small company compared to Amazon, so there should not be any regulator problem. There should not be any antitrust issue. So you buy iRobot at $40. The acquisition price was like $45 or $50. You could make 10-15% risk-free. Well, what happened is the acquisition did not work out. The CEO had to walk away from the deal. Afterwards, the regulators gave him a hard time. So what happened to iRobot? It's down 75% year to date. Now, if you looked at it at a risk-reward setup, the best you could make is 15-20%. But the most you could lose is 75%. I would never take this bet. Same thing with Spirit Airlines. And a lot of people make this mistake. Mohnish Pabrai was long Spirit Airlines because he was playing the merger arbitrage trap. And to me, it's a trap. And then it's down 72% year to date because the acquisition was, I believe, was JetBlue or Delta Airlines, fell through. It didn't work out by the regulators. It's down 72%. Now, yes, sometimes it could work out. You could make 15-20%. But if you could lose 50 or 70%, then a merger arbitrage is an easy way to lose money, in my opinion. It's absolutely crazy. I would try to avoid it at all costs. I think it's a massive trap that a lot of people fall into. It sounds smart, it sounds easy, and all that stuff. To me, most of them are traps, and it's just not worth the risk-reward setup in general. So I would avoid merger arbitrage investments. The second one, which I see a lot of people do, and this is mainly that you should avoid taking profits on a growing company. I'm sure you've had some stock, it went up 50 or 100%, and then you saw, oh, the stock moved too quickly. The stock is now overvalued, the PE ratio is high, so I have to take profits and move on. And after you take profits, the stock goes up 50%, 100%, 200%, and it keeps on going, and you have all these regrets. I shouldn't have sold, I shouldn't have taken profits. And a lot of people do it forever and they never really know what was the mistake. Well, the mistake is that once you have a growing company and you bought it at a fair multiple, and the company experiences a multiple expansion, it does not mean that the stock is overvalued, because maybe now the market and more people are realizing the potential of the company, so they are giving it a multiple expansion at a premium, because this is a growing company, and people realize that even though they can pay a higher price for this company, eventually the company is going to grow into the overvaluation that it's in right now. The best example of that is a stock like Nvidia. And it's the same thing with a lot of companies, even Apple. Apple was overvalued many times. Costco was overvalued many times. And these companies, they just keep growing into the overvaluations. Now, sometimes the stock is extremely overvalued. And in this case, I would be taking profits and moving on if I found something better. But if I have a growing company and it took a multiple expansion, I'm up 30% in 2 months, would I really sell it? If it has so much upside potential and is growing so much, I wouldn't sell it. So for me, it was mostly a mistake, and I took profits on Apple. I mean, I made this mistake myself. I took profits on a lot of things because they moved too quickly, and I forgot all about the long-term potential, all about the growth of the company, all about the long-term trajectories, because I was so focused on how much I was up on the stock, and I did not want to lose this percentage. So I decided to take profits. So all of these things I made mistakes on. For me now, if I have a growing company, it's not extremely overvalued and it keeps growing. Everything is, the CEO is doing the right thing. Everything is going the right way for the long-term potential. I would not be taking profits, even though it took a multiple expansion from 15 to 20 times or 25 times, and it looks overvalued on trailing earnings. But maybe forward earnings, or if you run the numbers 5 years from now on high growth scenarios that whatever the company is experiencing, maybe it's not as overvalued as you believe. So for me, taking profits just to take profits because the stock went up on a growing company tends to be a big mistake, and I've made it, and I think a lot of people make this mistake. Now, the third thing you should not do, or we should do is avoid selling your stock because the insiders sold. This is a really big one I see, especially on Twitter, even in my own group, many different places. People, they sell a stock, say, oh, the insiders sold. So the insiders must know more than we do about the company. The insiders believe the stock is overvalued. This is why they sold, or maybe they know something we don't know. So therefore, I'm going to sell the stock and move on because the insiders have sold. This is the biggest mistake I've ever seen people make. And I used to make this mistake too. And whenever you're looking at insiders selling, you should not be freaked out because the insider could be selling for many different reasons. But one thing you should look for, you should look at the track record of the insider. For example, something like, let's say, Palantir. Insiders have been selling for a while and the stock kept going up. So whenever you really want to know if the company is in trouble or not, or what I would do, I would look at whoever is selling the stock, whoever is the CEO, CFO, the director, and I would look at his track record, at his previous buys. Did he buy the stock before at a specific price, and is he selling it right now? Now, if this is happening, maybe he believes something has changed, or he might believe the stock is overvalued. But you have many amazing performing companies where the insiders have kept selling, have been selling for years and years and years, and the stock has been going up. So if you don't see the insiders that he actually bought the stock and then he's selling it, I would not be taking it seriously in terms of insider trading. This is one like Walmart. Walmart, look at how many they've been selling, the Walton family. They've been selling in 2024. You scroll down, there's no buys. Everything is a sell. 2023, 2022, 2021, 2020. 2018 they've been selling. 2016 they've been selling. The stock is up so much. And imagine you selling just because no one is buying Walmart and all the insiders are selling. Maybe they're selling for different reasons. I mean, you would have missed on a lot of upside with something like Walmart, or even with something like Nvidia over the last few years. So if the insider is selling, this is not enough of a reason for anyone to exit the stock. You have to look if they were also buying it at another price. But if no one has ever bought the stock and it's only been getting sold, then for me, I would not be taking the insider trading seriously. And you see it a lot on Twitter. Oh, Walmart insider sold or Apple insider sold. It's mainly to create drama, create fear, create attention. But it's not really something I would take seriously unless this specific insider bought it at a specific price and then he sold at another price. Or else I would not be taking insider trading seriously. Okay. Now the first one, which it's also important, is avoid shorting cult stocks or stocks trading at 52-week high. And this is something I talked about before, but I'm going to talk about it again. I'm going to explain what I believe is a cult stock is and the whole thing about 52-week highs. Now, for me, a cult stock is a stock that has something extremely irrational, either to the good side or going up, or it may be going down more than it should. Basically, it's a stock that has massive deviations from its fair value. It has a lot of either optimism or it has a lot of pessimism. It has a group of people that defend the stock no matter what. And if you're on the internet, I'm sure you've seen many of it. For example, try saying something bad about Tesla on YouTube. You will get a lot of comments, people angry because it's a cult stock. Same thing with Alibaba. Same thing with Nvidia, either because they made money on it or they lost money on it and they want confirmation bias. And I have nothing against this stock. I believe Alibaba is undervalued. I believe Tesla has a lot of potential over the long term. It's a little bit overvalued at the moment. I've done videos on it. I have nothing against these stocks, but it's a stock with a lot of extremes and a lot of emotions. Now, whenever you have a stock with a lot of extremes and a lot of emotions, things will tend to get more extreme because there's nothing that can prevent them from getting more extreme because it's already been extreme. You could say something like Nvidia. A lot of people shorted Nvidia and say, oh, because Nvidia is trading at 50 times earnings, this is overvalued. Well, if Nvidia got so irrational to trade at 50 times, do you think it can trade at 60 times or 70 times? You don't think we could have short squeezes on a lot of these stocks that just been going up? Or even something like Alibaba. A lot of people buy Alibaba just because it was cheap, and this is not enough of a reason. I always say that. I think the stock is undervalued. But a lot of people, let's say, oh, I'm buying Alibaba because it's trading at 15 times earnings, it's cheap. Well, it went from 46 times to 15 times, and it went to 9 times, and it could go to 6 times and 4 times, because Alibaba is in an irrational phase. There's no bottom on the stock, there's no level where, oh, it's too cheap to ignore. 9 times is too cheap to ignore, 12 times was too cheap to ignore, 15 times was too cheap to ignore. So this is what I believe cult stocks are stocks with extreme irrationality, and it could last way longer than you believe. And if you have a stock that's trading at 52-week high like Nvidia, you have nothing to base your thesis against. You have nothing, you have no level for you to cut losses. And you have a lot of the algorithms, they're trading against you because a lot of the algorithms and the machines are programmed to every time you make a new 50-week high, they buy the stock. If it makes a lower low, they sell the stock. Higher highs, they buy the stock. A lot of things like that, they're programmed to run on momentum. So you have the momentum traders working against your short positions. Now, the best short positions, in my opinion, is whenever a stock is making a lower high, like when I shorted the S&P and bought back many times in 2022. Every time it hits the trend line, on pretty much the top line, I would short the stock, mainly buying put options. Then I would buy it back and set the put up, but take profits on the puts, buy back the stocks. Then I would short it again, buy it back. So this is an easy trend for me to look at. But if you have a stock, it just keeps making new highs and new highs and new highs. You have nothing to cut losses. For example, I did lose money over here when I shorted the S&P one last time, but I cut losses because it went above the line. Now, if you have no line or nothing to go against or no place you know when you could exit and move on, and the stock keeps making you 52-week highs, it's a very bad position to be in. So I would never short a stock at 52-week high, and I would never short a stock that's a cult stock because the irrational could get more irrational and you're standing in the middle. I tend to only short indexes on special occasions. I try to avoid shorting as much as I can. But if I do it, it's mainly index funds and it's mainly through put options, not just straight shorts or borrowing the stock or anything crazy. The last one, which might surprise a lot of you, is to avoid tracking your stocks from your broker. You might say, what do you mean? Where do I look at my stocks? I have to open my broker, my Robinhood account, Webull, Fidelity, whatever you have, to track your portfolio to see how much you're up or how much you're down on the day. And this is something that I don't do. I only open my broker whenever I want to sell something or buy something, which I don't do it very often. And what I try to do, I try to track my portfolio from Yahoo Finance watch list, because I can look at my stocks in terms of percentage. Say, oh, I'm down 2% on Apple stock. I'm up 5% on the stock. Instead of looking at it from a dollar amount, I'm down 50,000 on the stock, 20,000 on the other stock. Because once you look at it in dollar amounts, you tend to get emotional. You say, oh, I put this much money here and lost this much money over there. And you look at it in dollar amounts, you get more and more emotional. And once you get more emotional, you want to end the pain because you're losing so much money. So you're going to sell the stock when you should be buying it, and the stock goes up and you have all these kind of regrets. So for me, to avoid getting too emotional with stocks, I look at them from percentage. I'm down 2%, up 1%, up 5%, down 3%. It's much easier than looking at them in dollar amounts. So I don't really get too emotional of how much money I'm making and get excited, or how much money I'm losing and get sad and mad and want to sell the stock to end the pain so I could feel better, and all these kind of feelings. This is why I have my channel. I named it The Patient Investor, not because I hold stocks for 50 years. It's because I try to tell people about emotional discipline. And I hope I could do that a little bit more on YouTube. This is why I try not to get excited whenever I'm right or get mad whenever I'm wrong. I just try to keep a neutral face and just talk about the facts instead of just getting excited and all these kind of things. But I think it could give you a lot of advantages if you look at your portfolio and your watch list instead of your own broker. You could try it out. It's going to give you an easier time. Maybe just open it whenever you want to buy or sell something. This is what I do, and let me know if it does work out for you or not. And this wasn't financial advice, of course, just my opinion on what I do and how I do certain things and mistakes that people are making. So thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.